One of the first decision-making issues for a client when they're considering starting a business or they have an idea for a business is the type of business entity that they should form. Whether they should form a legal entity or just remain a sole proprietor. And if they do form a legal entity, what type of entity should that be? And what should the tax status of that entity be? So there are several factors and several important considerations that go into making that decision. One of the first most critical components to that decision-making process is legal protection. Oftentimes clients are concerned that if they start a business, they need to assure that they have some legal protection as individuals from possible legal issues that may arise with the business that they're forming. And so it's very common for a client to want to establish a legal entity that will help to shield the potential legal issues that may arise down the road against them as individuals. And oftentimes the decision will then be to form a limited liability company. It's a very popular legal entity type that allows for an individual business owner to separate the business from them individually. The objective is to separate any potential legal issues that might arise from the business and from the individual who's forming the business. So a limited liability company is very popular and very often used to achieve that objective. What's important about a limited liability company is to understand that that's a legal entity type, and from an IRS perspective, there is no such thing as a limited liability company tax return, so to speak. So when someone forms a limited liability company, they may have achieved kind of part one of their objective, which is creating a legal shield, so to speak, between them and the business itself, but they still have to make a determination of the type of tax entity that they're going to be and how they'll be treated by the IRS for tax purposes. And so a limited liability company could potentially file as a sole proprietor if there is one owner of that limited liability company. If there's more than one owner, they could file as a partnership with the IRS. So in addition to the legal entity decision, there is the decision to make with respect to how that entity will be treated for tax purposes by the IRS. And it's very important to work closely with an advisor, generally a CPA, and oftentimes in conjunction with an attorney when you're making that initial decision to assess what the most appropriate legal entity type is for your business and what the most appropriate tax entity type will be from an IRS perspective. One of the primary differences between an LLC, for example, who has one owner and is filing as a sole proprietor, and an LLC with one owner who has elected S corporation tax status is how taxes apply to that individual business. There are primarily four layers of taxes, so to speak, in this with respect to this discussion: in federal tax, state tax, Social Security tax, and Medicare tax. And depending upon the selection of tax type, a sole proprietor filing an individual Schedule C, for example, or an S corporation filing a separate business tax return, how those four layers of taxes will be applied to each of those options is different depending on which direction you choose. So it's important to understand what the tax implications and the tax liabilities will be for one type of tax status versus another, so that as you're making the decision when you're forming your entity, you are basing it upon what the best tax benefits will be for you as an individual business owner once the business starts creating profits and incurring tax liabilities. And there are different procedures associated with having an LLC that is a sole proprietor versus an LLC that has elected to be an S corporation. For payroll, for instance, there are different methods of paying the owner under one circumstances versus the other. An S corporation would incorporate traditional payroll to the owner of that S corporation, while a sole proprietor would strictly take draw from the business and wouldn't take a traditional payroll. An LLC with one individual owner is a sole proprietor by default and would file a Schedule C on their personal income tax return. That's kind of the default scenario if you do nothing else after you've formed an LLC and it's one owner of the LLC. Through the S corporation, the owner would receive payroll and would pay federal and state taxes on that payroll and be subject to Social Security and Medicare taxes as well. However, the distributions that the owner of that S corporation would take out of the business above and beyond any payroll that they're taking out of the business would not be subject to Social Security and Medicare taxes. So there's the potential for an S corporation owner to receive compensation in distributions that in total would result in a lower ultimate tax liability than if they were simply a single member LLC filing as a sole proprietor, where all of the profits, all of the distributions in effect are subject to federal, state, Social Security, and Medicare taxes. So there's different ultimate taxation depending on the election and the option that the entity chooses from a tax status perspective. So again, it's important to understand what best serves the individual needs of the owner from a tax perspective, and also look at the different components of how the owner will be paid once profits start to develop in the business and need to be distributed out to the owner. There's very important elements to an owner of an S corporation or an owner of an LLC with respect to debt, because obviously oftentimes an owner is trying to establish a debt arrangement with a bank, for instance, so that if there was an issue, a default issue or some type of issue with paying the loan back, the objective would be for the business itself to be legally responsible for paying that debt back and not necessarily the individual owner. It's very difficult to accomplish that in the small business world because oftentimes a bank is going to lend a business money with the guarantee of the individual owner as well. And so regardless of the protection that you've established as an owner with an S corporation or with an LLC or any type of legal entity, once you've made that personal guarantee, it's difficult to separate yourself as the owner from the obligation on that debt. However, the more established the business is, the more profitable it becomes, the better the potential is for that business to establish a loan arrangement with a bank by itself and not have the owner be individually responsible for the repayment of that debt. So that if something did occur down the road and there was the need for bankruptcy or default on that loan, it's possible that only that business entity will be responsible for the repayment of that debt. So what's most important, usually from a small business individual owner perspective, is how can I limit my legal liability if something ever arose from a legal issue or type of circumstance, or how could I minimize my tax exposure on the income that I'm creating. It's very important when a small business owner is establishing an LLC or a corporation for that matter. I mean, it really doesn't make too much of a difference in that respect, but that they understand that they're creating a theoretical shield between them individually and the business with respect to potential future litigation or legal issues that might arise. But there's no perfection to that from the world of court systems and lawsuits. Generally, someone who's making a claim is going to try to sue any and all parties that are associated with the issue, including the business itself and the owners itself. And so in terms of kind of piercing the shield of that corporate or LLC protection, what becomes important is working closely with your CPA and your attorney to establish the correct documents and go through the correct procedures when you are starting an entity to assure that you have all of those pieces in place to protect you in the event that something like that arises. Oftentimes what's looked at is the true separation and distinction between the business itself and the individual owners. And by that meaning, it's clear and concise to the market in general that there are the business is itself a separate legal entity, and the owner and the business are not one and the same. So that would be things like how you conduct yourself in the general marketplace, how you keep your books and records, how you maintain your legal documents so that it's clear that you truly do have a separate legal entity from the individual owner. And the less clear that is, the more potential there is for that shield to be pierced in a court matter. As a small business owner, it's difficult sometimes to assess that you're going to basically have to pay 40% in taxes on whatever profits you create. And so you're looking for ways to minimize that obviously they're legal and they're the part of the tax code, and that's where strategies like an S corporation can play into the ability to at least minimize or limit what that overall tax exposure is, and maybe try to change it from 40% to 30% or something like that. So in kind of the small business world, the more realistic approaches are to try to limit liabilities and tax exposure and create as much of an ultimate benefit to the bottom line so an individual owner could reinvest back into their business.